There are 4 truths about money that banks don't want you to know. And how you're told to make money and invest is not the way the banks and financial institutions make their money. Banks aren't profitable because of how much they allocate to a retirement plan, and they're not out there just to take risks, because if they do, they lose. They don't wait for 30 years for their investments to finally pay off. They make money immediately, and they focus on a completely different methodology and philosophy than what they would tell their clients to do. And you can start to think more like a bank and even lower your risk and improve your cash flow. Look, if you don't fix this, everyone that tells you it takes money to make money will keep making money on your money, and you're going to end up with much less than you could, should, or thought you would. Isn't it interesting that banks have like the biggest buildings in almost every city? They love to give out money to those who don't really need it, right? If you're in a good situation, here you go. If you have collateral, if you have great cash flow, if you have the money to pay them back, they love to lend to you. And at the end, they give you a sucker. But if you're in trouble, forget about it. They're not in the business of bailing anyone out, yet our tax money has bailed them out before. So it doesn't take their money to make money. It takes your money. That's the first truth. It takes your money for them to make money. That's it. Your money. Arbitrage. They earn double and triple digit returns on the spread. Look, if they're giving you 1% on your money, and they even turn around and lend that out for a really low interest rate car loan at 2%, buying something for $1 and selling it for $2 is 100% markup. That's the spread. And let's face it, they don't have a product. They're just an intermediary. So they're taking people's money, and then they're turning around and lending it out. So they rent your money for a very small amount, and then they rent it out for other people to a much larger amount. The second truth, you are the product, also known as you're the risk, and you're part of the way that they manage the risk. They want to look at things like your credit score to say, well, are you going to be able to make payments over a long period of time? They want to look at what's called your seasoned funds to say, how much money do you have in cash or do you have immediate access to? They'll even look at the amount of available credit that you have. So do you have paid off credit cards but have really high limits that you could tap into? That's all things that they might look at. But even if you go to buy a home, they want you to do things like get an appraisal. Now, if it's a jumbo loan, they might have you pay for 2 appraisals and not just one. But you're paying the appraisal to say, what if you can't make a payment? What's their collateral? What's the backup plan? But banks aren't really in the business of buying real estate. They're in the business of lending money. The real estate is just the backup plan. So even if someone found one of the best real estate deals around, but they had terrible credit, no seasoned funds, no down payment, the bank's not really going to care about that appraisal. They care about, are you able to make payments on a monthly basis? They are in the business of cash flow, right? Pay less out to all the people that make deposits, take more in to all the people they lend money out to, and that spread or that cash flow is their profitability. So they're good at risk management. They want appraisals. They want a down payment, right? If you go get a mortgage, you make a down payment. If you make enough of a down payment, there's no PMI or private mortgage insurance. Now, if you don't make enough of a down payment of like 20%, then you're paying an insurance fee in case you default, again, protecting the bank. So they're an intermediary. They have to be a steward over the money. They're focused on cash flow. They're making money on your money and ultimately managing risk. So cash flow, I kind of talked about that. That's the third truth. They offer low interest rates for shorter loans or lower interest rates to entice you to increase their cash flow. Part of it's because it's lower risk if they have more money coming in a shorter period of time, right? Because they don't know what you're going to, situations like 10 years, 15, 20, 30 years down the road. So if they can get you to a 7-year loan, that's going to be better for them than maybe a 15-year loan, especially since most people move or they refinance. And ultimately, the more equity there is, because you're paying down the loan, the more protection they have with their collateral. So they entice people out of times with lower interest rates to shorten the loans, even though they're telling you longer term loans have huge amounts of interest. But one of the things they don't want you to understand is cost of money. How much can you earn on your money versus how much do you pay to borrow money? There's always an interest cost, whether you pay cash and forfeit the right to earn interest on that money, or whether you borrow and you pay someone else interest so you can keep control of your cash. Excuse me for just a second. I know I'm interrupting your video, but it's because I'm really excited about this. Disrupting Sacred Cows, my newest book. It's new, it's fresh. It's about all of the things that have to do with our relationship to money, the things that hold us back and how to, kind of peek into that. be able to resolve that. And ultimately, with the new economy and everything that's happening and moving so quickly, it is timely to help you to have more success in your finances. So go ahead and click the link if you want to grab this book and dive on in. Now, for most people, they're not able to invest and get better returns like a bank might get on your money. So maybe it's the best thing to do is just to pay those loans off. But how you pay them off is very important, and I have other videos on how to do that. But think about it like from a bank standpoint. They're in the business of cash flow, not just accumulation, not waiting for 30 years, not high risk equals high return, not it takes money to make money. Yet this is the methodology they've been teaching everybody else. That's not the way they invest. They invest a completely different way. They play a completely different game. So focus on cash flow, focus on risk management, and in the right circumstance for the right investor, maybe there's ways for you to make money on other people's money. Now, the final piece here, and this is a big advantage for banks and institutions, is they can fractionalize. Fractionalized banking is where a bank can lend out money and they use that money more than once. So if you get a loan of $1,000, you go take that $1,000 deposit into another bank, they have a reserve requirement. They've got to save like 10% of it, but then they can lend the other 90% out, even though that was borrowed from someone else, and then you just deposit it in another bank. So the same dollar might be lent out like 6 different times. Yeah, there's that reserve requirement, so it's not the full amount that can be lent out, but if it's circulated enough, we've got the same dollar lent out over and over and over again in the system. Therefore, they're earning interest on money that's not even real money. It's kind of made up money in fractionalized banking. Let's review this. It doesn't take money to make money. If you're a bank, it takes other people's money that you're then renting, and then you're selling or renting out for a lot more, and you can get double or triple digit returns. That's the spread. There's no product, they're just an intermediary. You want, as an institution, a bank, they're into risk management, yet they're telling everybody else, high risk equals high return, wait for 30 years, accumulate. So a lot of people are taking unnecessary risk with the institutions, getting appraisals, down payments, seasoned funds, credit scores, looking at taxes, making people pay for private mortgage insurance. They're in the business of cash flow. They're enticing you on any way they can increase their cash flow and lower their risk. Those are 2 major factors. And then finally, they're fractionalizing when it comes to their money. Would you like more money? Would you like to be able to utilize that money in a way that you could enjoy life along the way? Well, I've decided to tackle all things money, whether it's keeping it, whether it's growing it, whether it's being more efficient with it, or whether it's just knowing where you're at with it so that you don't feel confusion. So if you'd like to cut through the complexity and be reassured that it is possible to simplify your finances and enjoy your life along the way, well, just check out the next video.